Good afternoon from one retail investor to another. This is Trader72. I hope you are well. Welcome back to my show on this afternoon, end of week-ish. Nearly there, and it's a great day. After a very sunny day yesterday, actually. I was in the garden for a little while, but now we are back for another one. I've had a few shows uploading this week, which I hope you will all check. But today is going to be about Microsoft, the mighty Microsoft. I thought I'd go into a little bit of an analysis about it, just as one individual company, because the last few times I've done quite a few groups of companies. But this time we're going to concentrate mostly on our Microsoft and where's Microsoft's situation at the moment. Once the darling of the stock market, no doubt about it, one of the big Mag 7, of course it still is, but has recently suffered in form for various different reasons. As you can see from this graphics to start off with there, Microsoft is one of the worst performers of the Mag 7, down about almost 28% off its highs compared to some of the others. There you see Alphabet and Apple down as well. Amazon still up 58%. I mean, that's debatable, of course, on where you're looking at where you bought it. But certainly from that point of view, performing definitely one of the worst there for obviously different reasons. So today we're going to go through the meaning of the business, which everybody knows, but it's always good to recap. I mean, you never know. Some people may have slept under a rock for the last 30 years, but I doubt it. So, and also a bull case, a risk case, big questions about their AI spending and about Azure and about Copilot. And what is the investor's angle in terms of business and where it's at? And just to close off the line, really, a kind of an idea of where I would I invest or not at this point? So I think this is the kind of questions that we've all got to ask ourselves. So let's start without further ado with the ecosystem. What does the company do? We all know that it is basically a subscription-based business. It basically obviously has Azure as one of their main now business earners, of course, cloud infrastructure. Obviously, it has business processes such as Office 365, LinkedIn, and obviously subscription-based SaaS. Obviously, it owns as well Windows, Xbox, Surface, again, all subscription-based. So this are obviously very good earners. And obviously helps massively with the revenue in that respect. It's expanding obviously massively into an AI revolution, obviously, which is, well, everybody is. Who doesn't these days? And obviously is moving into embedding AI Copilot and so forth. Now, we can go to that in a minute in terms of what these businesses actually mean. Obviously, some people may not always be aware of some of their products and what exactly it does. Obviously, in terms of moat, now, as you all know, I like a criteria. My criteria is about understanding the business, the moat, the management, and of course the 4 M's. So that's the 4 M's that we call them. I learned this from Phil Town, his Rule 1, a very useful book which I advise you guys to read, and that is a very, very good way to go through a certain criteria which everybody should do as an investor, even if it's a short-term investor or long-term investor, medium-term investor. This does give you an idea of how to look for, search for your company and before you invest in one, and will they tick all the criteria. So my preference is obviously that all 4 do tick, and most of the time they do if you look for the right company. So in terms of moat, it is a huge moat. It's got Excel, Azure, Fortune. It's basically, as it says there, the heart transplant of many, many different businesses. It has a massive network effect with LinkedIn, which basically half the business community uses. I certainly use it myself, especially in the where my number one job, or used to be my number one job, in the film business. So certainly it is there to stay. It is a castle within a castle within a castle with a massive moat around it, and I don't think it's been certainly not been challenged in that respect. So I think this is definitely a business that has a moat 100%. The fundamentals. Now, let's get to the fundamentals, because obviously it is, again, just to show you how solid the business is, even regarding, the business as it is and the issues that it's having at the moment. But every business goes through some kind of issue along the way. But the fundamentals are also very, very important part of the criteria, again, of the search to find the right company with the right story behind the company, the actual, what the company embodies, and the share price coming together. And this is where it's really important to do your research. So fundamentals, as you can see, they've highlighted pretty much. I'm not going to go too much getting in detail. We've only got a short period of time. I don't want you guys to lose patience in terms of too many numbers, but it is important to obviously check the basic numbers, the revenue, the growth, the net income, the profit margins, and the free cash flow, which is all important. And as you can see, over a period of 10 to 5 years CAGR, it has improved across the board. 12%, 14% on revenue. So obviously it's gone up by about 2.5% every 5 years. Revenue growth gone up from 13 to 15%. Net income from 16 to 18% there, as you can see. Profit margins have gone up every year for the last 10 years, and it's currently at 38%, a 38% profit margin, which is not bad. Free cash flow is also gone up year on year for the past 10 years from 11 to 12%, and it's currently got a free cash flow of $74.2 billion. Not small cash there, guys. The market cap's currently at 2.81 trillion. That's what the company is worth. That's what you would buy the company tomorrow, at $2.8 trillion. Yes, I do repeat that because it is staggering how those companies are worth, how much they're worth. The debt to equity is basically what the current debt is. Obviously 2.81 market cap versus the EV, which is 2.84, which means there's a slight amount of debt. So obviously, the more on the EV, the more that's where the debt sits. And currently it's minor, and it's 0.38. So the debt to equity is 0.38. Anything under 1 is very healthy, of course. And also, the important thing for you guys, and I've said this many of times in different videos, it's all about the company. If it's got some kind of debt or leverage, it's how quickly can it pay back that debt with its current free cash flow. And that's really important that you guys check that out. So, ROIC, obviously, that's the return on investment, which is the most important part, I think, of research. Normally, a minimum of 10% is what the company puts back into the business in terms of paying off debt or paying off a dividend or reinvesting in the business as a general. It's currently at 26%, so that's quite high and obviously way above my criteria, which is great. It has done some acquisition in the last 5 years, $85 billion. So the biggest one recently was Activision Blizzard, obviously the game maker, and of course the deal with OpenAI, which obviously we will come to, of course, later on, obviously. So that's kind of the fundamentals of what we are at the moment. I think we could probably go back to just give you an idea again of the free cash flow in some of the charts there again, just to kind of reinforce. We can go very quickly. As you can see, the free cash flow has suffered slightly with the capex expenditure on AI. We'll come to that again in a minute. As you will see here, the revenue has gone up year on year since 2019. So the staircase effect, I call it, that's something that is definitely positive. And obviously the free cash flow along the way has obviously gone up as well. So again, an interesting chart there in terms of where the market, but as you can see, year on year going up in free cash flow as well. Cash flow, again, as you can see, has gone up from 2018 pretty dramatically. Again, now slightly sliding because of the expenditure. Microsoft free cash flow per share, again, from early doors 3.2 to 8.4 trillion in a space of less than 10, well, nearly 12 years now. Again, capital expenditure is rising fast. Obviously, operating cash flow as well at 46.27%. Capital expenditure recently has been $69.2 billion, so an incredible amount. And let's move to the juicy bit, which obviously is the good and the bad. What's going on with Microsoft and why it has been so badly punished by the stock market. We'll come to the charts and the actual intrinsic price at the end. But again, Azure has been the main plus for Microsoft for sure. 39% year on year, as you can see there. Again, I've highlighted it in just this year alone in 2026. Gaining traffic share faster than AWS. The only minus to that is that their cloud segment or their cost of revenue has gone up to 44%. So they've got to work a little bit harder towards making that profit on Azure. So that may have affected slightly the share price initially. The big issue, I think, at the moment with Microsoft is the fact that obviously this concentrated partnership with OpenAI, it has been something that Microsoft has never had a concentrated business. It has a various different business which has made them money and have made them, made the revenue and the profit move in the right direction. But this time around, for the first time, they are quite self-reliant on what OpenAI can achieve. And we know that OpenAI recently is fighting, market share with various different other AI tools, and it certainly has slightly struggled for market share recently. So obviously value equity. So OpenAI's control separation. So the looks like the honeymoon, as it says, is over. Microsoft has a 27% stake in now, valued at over 135 billion. So that's actually probably a positive side. Guaranteed revenue. OpenAI is contractually obligated to spend $250 billion on Azure services, obviously reusing the cloud there. And of course, it has an IP protection on all OpenAI's models right up to 2032. The minus to that is obviously OpenAI shocked to the market in 20 by signing a deal with AWS, which obviously they're big rivals, which I don't think went down too well, breaking Microsoft's exclusivity to compute. So that's obviously that. Now, OpenAI has also burned some serious cash, recently cancelling Sora, which obviously was an app that was delisted just only last week or a couple of weeks ago. It was bleeding $15 million a day. So that was quite a substantial amount. So they've abandoned the whole app on this. Sora obviously can be imitated by certain companies, and it was obviously quite an issue. Disney, they had an issue. Obviously, the partnership was going to happen with Disney to use Sora. The landmark $1 billion licensing deal between OpenAI and Disney was officially scrapped as of March 2026. It would have allowed users to legally use Disney characters with Sora. But the partnership effectively collapsed for various different reasons. We know for the fact that obviously it can be faked by various different, so it didn't have protection. So that was obviously a big issue there for Disney, especially with their Disney characters. So that was down the toilet, so to speak. The other side, so Copilot is effectively a AI helper that sits beside you to write code, analyze, summarize info, automate this. So it's a bit like, again, an AI agent. It can help you with write documents, Word documents, Excel, draft emails from Outlook, summarize meetings, and general AI assistance. So just to give you a quick background, or a bit of background on what Copilot does, and obviously it will be very handy in the future for anybody that works in an office or has their own business, or even someone like me that does research for companies or research for various different recruitment as well. Now, the latest news is that they've come up with a thing called GIT Hub, or Git Hub, I'm not sure if I'm pronouncing that, which has been a hit. So that's on the plus side, 4.7 million paid subscribers, generating over 1 billion in annual recurring revenue. And it's the gold standard for AI tools. Total, Microsoft have finally revealed has 15 million paid seats. Now, that's all good and done, and that's obviously a great add to the revenue for that. The only issue with that is it only represents 3.3% of total Office users base. So Microsoft has had to do a heavy discounting on that, which obviously, again, is not great for the bottom line, and offering 50 to 60% discount to large enterprise. So again, Copilot, not a great start, but it looks like it's gaining traction on one side, but on the other, of course, a lot of these companies are stuck in pilot mode. So that's also the issue. Now, obviously, there are other issues, and I think we've got to go back to what was discussed there. I think we'll go back to this information there about the latest numbers that came out in Q2 this year, and why there's been issues which we're going to bring in terms of this 625 million spend with OpenAI. So let's listen to these guys there.
Microsoft's quarter includes net gains from investments in OpenAI. Are we going to get a little bit more of a picture about that and what's going on there?
I think the question I have is, there's a big number that, that 600 plus billion RPO you mentioned. There is a large portion of that comes from OpenAI. So the big question is, how is OpenAI going to fund this thing? Do they have the capital to actually fund, let's say, a 200 plus billion dollar commitment? But other than that, what are other clients spending that are not OpenAI? And, how is that business going? And if that wasn't the case, how should we look at Azure growth in the coming quarters? I think those are the big questions that we need answered right now.
Yeah, so that's clearly some answers to be answered there. So in early 2026, Microsoft reported the commercial remaining performance obligation, RPO, which is the total value locked in for the future, that skyrocketed to $625 million. So that is quite a commitment, obviously, regarding that. So I think that's probably not helped the share price on the back end of that. I think it was more than what people expected, or especially analysts expected. And the share price obviously sold off 10% on the back end of trade update Q2. So that is the problem. The concentration risk on OpenAI is becoming a bit of an issue for Microsoft. And I think that the most alarming detail of the report was the 45% of that 625 billion, roughly $281 billion, is attributed solely to OpenAI. So it is very much a reliance. Investors realize that Microsoft is heavily dependent on single partner for the future growth, which Microsoft has never done before. And I think they're trying to kind of renegotiate that contract at the moment to try to see if they can wriggle themselves out of it. So it's Michael. I mean, again, this is quite an important part here. The circular revenue worry, because Microsoft's investors in OpenAI. Critics argue that it looks like round tripping. Microsoft gives OpenAI, and OpenAI immediately promises to spend it back on Microsoft Azure cloud. So obviously, Azure will obviously rely on OpenAI respending their money onto the Azure. So that's quite a large chunk of cash, which could affect Azure's future numbers in the future. So that is a problem. Now, the well-known issue of the CapEx spending as well is a big issue at the moment. I think that over year on year, they're spending over $200 billion on AI infrastructure. I think all Mag 7 are doing it, but specifically Microsoft seems to be catching up on further spending, which maybe the other Mag 7 may have been ahead over the past few years. So it's had to have quite a big catch up in terms of refinancing their restructure and so that putting up together their infrastructure. And it seems as if the capex at the moment, based on this quarterly capex, is at $37.5 billion. So obviously, as a result of that, the free cash flow is going to be nearly $6 billion down. There's a few other good news there. Higher value adaptation. 80% of the Fortune 500 are now using Microsoft Power Platform. So the business world is heavily relying on the business of Microsoft, which is second to none in terms of moat in that respect. And I think that's something that you guys need to obviously definitely keep in play. Copilot seats now grew by 160% year on year to 15 million. So again, another major plus. And I think this is going to obviously clearly all kick in at some stage. That's personally what I think. Anyway, we've already gone through the revenue. I think the revenue is second to none at the moment as it stands. And obviously, while there's critics about the IPO with obviously OpenAI and the concentration, there is nevertheless still $344 billion worth of backlog comes from thousands of global enterprises, which obviously will come back in play. A quick idea of the PE ratio. Now, let's get into more the nitty gritty about what I think and where we're at with Microsoft. I've given you really a kind of the good and the bad in terms of, just to recap, the business, the fundamentals are strong. There's some good about obviously Azure obviously being up nearly 40% year on year, but on the other hand, the OpenAI concentration is a worry, and obviously OpenAI eating cash and cancelling various different pilots as well, and software applications, such as Sora has been a worry, and the fact that of course there's this concentration of 625 billion, which is to be with OpenAI. The Copilot has been a little bit of an up and go start. It seems like it's now finally getting a bit of traction. And of course, the big elephant in the room, which is the effect of the CapEx spending, which is costing their free cash flow quite a bit of cash and affecting the free cash flow by quite a bit. So there is certainly issues there. I think that it's still a very strong company, but in terms of P ratio and, you know, just give you an idea of how cheap they are at the moment, or cheap-ish, not cheap yet, I feel, is on average 31.4, and it's currently at 21 times earning. Yes, the mighty Microsoft is at 21 times earning, the lowest it's been in a 5-year at the moment. Now, the DCF model. Now, let's get to the actual true worth of the stock, not the market's share price. Currently at the moment at 360, I think it's currently at 366. We'll have a look at the chart in a minute. Now, this is how, obviously, the DCF model, that's the one I worked out. I'm sure you guys have seen this quite a few times if you have followed. If not, I work my intrinsic price, the actual true worth price of the stock, based on a 10-year DCF model, and this is based on free cash flow, the potential growth, obviously going forward, discount rate of 8%, which is a normal discount rate over the next 10 years, terminal growth beyond the 10 years of 3%, which is in line with GDP, and how many shares are outstanding. Now, once you do the calculations of all this, I'm keeping this simple, it works out as an intrinsic price of $489. That is the true worthy price of the Microsoft. A little bit like working out the true worthy price of your house, as it stands, bricks and mortar. So that does give us a minimum of MOS of $367. So that is my minimum criteria of buying into a company. 25% discount off its intrinsic price, the true price of what I feel it would be worth. So obviously that will obviously give you a margin of safety, which is why it's called a margin of safety. So if the stock does fall, you've already got a discount on that price, and it doesn't hurt as much as if you're buying a company overvalued. Which does bring me to the point that I think, for me, Microsoft is definitely investable. It's one of the big seven. It has a huge earnings potential. It is also fundamentally, number-wise, absolutely still one of the strongest companies on the market, and its margins are amazing, and its software and its products are never going to be replaced, I don't think, in that respect. I know this is quite strong words, but I do believe that if you're going to ask me again the question, will Microsoft be around the next 10, 15, 20 years? Absolutely. And I think Microsoft as a company will definitely be up there and bouncing back. We saw it with Google a few years ago, last year, when Google were apparently dead and buried with OpenAI, and Google bounced back and now probably one of the strongest Mag 7. And I believe Microsoft will be in that ballpark at this moment in time. So I think that's my kind of verdict. In terms of numbers, the P ratio is cheap. At the moment, the stock price is well off its highs, and it's nearly there. So, which does bring me price at the moment would be around $360 a share. So a little bit more time, a little bit more down, and I think I will start buying into Microsoft. So that is where I stand as an investor. Definitely worth investing, but at the right entry point. So you guys do your own due diligence on this. Please don't copy what I've just said, and make sure that you feel comfortable with your system and that you feel this is the right time to buy in. But that is my opinion on Microsoft. Look, actually, while we're at it, at Microsoft's share price and chart at the moment, it is currently at 367, so literally bang on 25% discount. Which is great news. It's below its 200-day moving average. I can never say in one word, so apologies. Currently in selling mode. I mean, its MACD there is clearly in sell and still selling quite hard. And of course, the Stoich there, momentum-wise, is still oversold, but maybe with a slight crossover there on the one of the red lines. So I think in a way at the moment you might be better off sitting on our hands and waiting for that magic number of about 360 and below, and then you would get yourself a proper bargain. I mean, look, we know that it has fallen as far back here as $353 a share. Obviously last year's April was even lower than that, but this is the big turning point there, the below the 200-day moving average. So I think that's quite an interesting point. So I think it can get cheaper before you buy in. So up to you guys to see what you think about that. So, look, just a bit of quick news just to catch up on the back end of this, which is what I've been doing for the last few uploads that I've done. It looks like there's issues. The markets have gone back into the red today. I think that, let's be honest, the huge uptake yesterday Huge amount of obviously short-term buyers were in yesterday on the back end of the ceasefire for 2 weeks, but it looks like this is very, very fragile at the moment. It looks like the Middle East, the Iranians have asked the Israelis to stop bombing Lebanon and obviously Hezbollah, and of course it doesn't look like the Israelis want to do that. So, and then it's not part of the deal. So it has made the situation a little bit fragile. Looks like Trump is keeping most of the army in that region at the moment. And the PC number came in line as well, by the way, which is obviously one of the preferred gauges by the Feds. It looks like it's still pretty much at 2.83%. So no changes, really major changes there for the market. But I think it's more about what's going on in the Middle East, which is kind of wobbling slightly the States at the moment. Just have a quick look on the news there for you guys. February PCE came out 2.8, as I've just mentioned. And it looks like the rally of yesterday has certainly been tampered. Now, on another bit of news, I have just bought into Uber, back into Uber. I sold off just before the deadline on Tuesday night. Was happy to try to look at buying it slightly cheaper than I did initially, which was about 72, and I've rebought in at 71.5. Now, on hindsight, I wish I probably waited a bit longer to maybe even buy it at the price it's at now. So as you will see, I've added this back into my portfolio at the moment. I did keep my position in oil, and you can see oil's gone back up again because of the fragile situation going on. I think until there's actual peace talks and they'll sit down and talk about things, meeting tomorrow, I think the markets will possibly settle down a bit more then. But until then, it looks like it is very wafer thin in terms of the agreement, and I think things could kick off at any time. So be careful, guys, before you buy into any stocks or into any commodities. I would certainly sit on my hands and wait and see. On hindsight, possibly I should have maybe waited a little bit longer on Uber, but it's only £38 in the red, and I'm pretty happy that I've bought slightly cheaper, and I will buy more if it drops. So I'm actually happy for the markets to Uber to fall slightly further down for me to buy more, potentially, because I am pretty sure that Uber is a good buy and a great investment. And again, Uber, unlike Microsoft, is at 50% discount, so something to bear in mind. But again, please do your due diligence on that and don't just copy my current buy. I'm only here as advisory, to say the least. So there we go. So US 30 down 120 points, Nasdaq down pretty flat, really, I'm honest, and oil's gone back up from 94 yesterday to back to 101. It is like a yo-yo out there at the moment. The volatility is amazing for the past 4 or 5 weeks after a pretty steady rise up back in 25. This has certainly been a turbulent year, guys. Let me know what you think about my Microsoft analysis. It was pretty brief, but it gave you an idea a little bit more of the pluses and minuses of why Microsoft is at the moment. Any questions or any comments, please make them below. Always happy to answer the questions. Please subscribe and like. Always important for any young, well, not me young, but young channel as we are, or as I am, as Trader72. Please enjoy the last few uploads from this week. So there we go. We are done. From one retail investor to another. This is Trader72. It's over and out, and we'll hopefully see you maybe one more video before the end of the week. See where we are with that. But at the moment, it is a little bit anxious. The markets are anxious, and you can see it there from the screen that it is pretty much waiting to see which way this might go. So let's see, guys. Take care. See you soon.